In the US, the middle class and less privileged are left to fend for themselves. It's true that trying to save or invest in profitable stocks is a good way to build wealth, as this is proven by one of the world's wealthiest men, Warren Buffett, but that isn't enough. Building wealth can be faster and easier with lower taxation rates. The taxation system in America can be a bit complex, but here's the brief breakdown. There are different taxes for different reasons. For example, there is an income tax, which requires taxpayers to pay the government a percentage of their generated income whether they are self-employed or have an employer. There's also the payroll tax, which requires an employer to pay for Social Security and Medicare programs on behalf of their employees. Corporate tax is tax taken off corporate profits by the government to fund federal programs. There are other forms of taxation which include inheritance tax, sales tax, property tax, estate tax, and even tariffs on imported goods. How exactly does tax deductions affect a person's wealth? And how do rich people use insurance as a way to escape the claws of taxation? The premise of tax is simple. People pay the government a fraction of their income to enjoy things like subsidized education and healthcare, good road network, basic amenities, and even security. But how is this fraction of income calculated and paid? The first thing to know is that the US taxation progressively increases as an individual's income grows. There are 7 federal tax brackets that a person can fall into, and these brackets have tax rates going from 10% to 37%. So a person's tax doesn't remain constant, instead it is expected to increase as they earn more and more. That would mean that the tax liability for a low income earner would be low, for a middle class earner it would be a bit higher, and for the rich folks, tax would be on the higher side. That is what the tax laws state. But what if there was a way for rich people to legally bypass taxation laws? It means that allows the rich and wealthy to not lose any of their hard-earned money to tax. Rich people in the US can actually legally avoid paying the high taxes demanded of them simply by buying an insurance policy. There are a lot of life insurance policies available, ranging from whole life insurance, term life insurance, universal life insurance, variable life insurance, money back insurance, child insurance plans, and even final expense insurance. The point of these insurance policies is simply to stay ahead of unpredictable life occurrences, from natural to man-made disasters, sickness, and even death. These insurance policies build cash value and transfer wealth to future generations, and that is exactly the point. The most common type of insurance policy to take out to achieve this is the irrevocable life insurance trust. What the irrevocable life insurance trust does is allow the policyholder to control how their assets are distributed after they die. It helps them protect their assets from creditors and avoid estate taxes on life insurance proceeds. The grant creates an ILIT and pays for the life insurance premiums. The grantor transfers control of the ILIT to the trustees. The trustees make sure that the beneficiaries, who would be the main policyholder's family, receive the assets in the trust. The irrevocable life insurance trust is a trust that cannot be rescinded, amended, or modified or post-creation. Once the grantor contributes property or life insurance death benefits to the trust, they cannot change the terms of the trust or reclaim any of the properties held within. As an alternative to naming an individual beneficiary, ILITs offer heirs several legal and financial advantages, including favorable tax treatment, asset protection, and the assurance that the benefits will be used concurrently with the benefactor's wishes. An irrevocable life insurance trust is often used to set aside assets for certain purposes, such as paying estate taxes, because these assets themselves are not taxable. In order to do this, the selected assets must be moved into the trust at least 3 years before they are used. Some people create new policies in their spouse's names to circumvent the requirement. If properly structured, the death benefits paid to the ILIT will be free from inclusion in the gross estate of the insured. This differs from a scenario where life insurance death benefits are paid to an individual because the proceeds are included in the taxable estate of the descendant. Consider that the 2025 federal estate and gift tax exemption is $13.99 million. In 2024, it was $13.61 million. While most estates aren't that substantial, states in the United States begin taxing estates that reach values of $1 million or less. This can be an easier figure to arrive at than one may initially think. For example, a benefactor with a $600,000 life insurance policy who owns a home worth $400,000 would trigger a tax consequence for their beneficiaries. On the contrary, removing the life insurance portion from the estate by placing it in an ILIT lets the benefactor help their heirs avoid estate taxes. If the insured has beneficiaries who are either minors or adults with histories of reckless spending habits, the creation of an ILIT with a trust as a beneficiary can help minimize irresponsible behavior. The ILIT will also provide a level of asset protection for the beneficiaries in the event that they become embroiled in future litigation. This is because ILITs are not considered to be owned by the beneficiaries. This in turn makes it difficult for courts to link the assets to the beneficiary, rendering them nearly impossible for creditors to access. So, the rich people don't make this insurance move for themselves, they make it for the people who will inherit their estate. By using an irrevocable life insurance trust to avoid taxes, rich people have been able to protect their wealth and generation of heirs for many years. It is important to know that this method of avoiding heavy taxation on inherited assets is quite legal. By opening an insurance policy and transferring assets to a trust not under the policyholder's name, the beneficiaries can end up paying far less tax than they ought to. What are the advantages of using insurance policies to avoid taxes? Well, an ILIT might sound complex, but it is actually a very clever way to use life insurance to minimize taxes and ensure loved ones get the most benefit from insurance policies. By transferring ownership of a life insurance policy to an ILIT, policyholders are effectively setting up a structure that helps avoid a lot of potential taxes while offering other financial protections. So, here are some of the benefits of using an ILIT for tax avoidance. The first is to avoid estate taxes. One of the biggest reasons people use an ILIT is to keep the death benefit of a life insurance policy out of their taxable estate. When a person owns a life insurance policy directly, the IRS treats the death benefit as part of their estate, which means that if the estate exceeds the estate tax exemption limit, the beneficiaries could be hit with hefty estate taxes. But when there is an insurance policy, it removes the death benefit from the taxable estate. This means the IRS can't tax the estate when the policyholder passes away, and the beneficiaries get the full payout without losing a significant chunk to taxes. The second is a tax-free death benefit for beneficiaries. With life insurance, death benefits are typically income tax-free for the beneficiaries, and this is already a great feature of life insurance. However, if the policy is owned directly, the IRS might count it as part of the policyholder's estate and subject it to estate taxes. But when the policy is inside an ILIT, the death benefit is shielded from estate taxes altogether. This means the heirs get a larger payout with no estate taxes eating into it. So putting the policy in an ILIT allows holders to pass along wealth in a way that ensures their loved ones don't face a huge tax burden when they're gone. Third is gifting without the gift tax hit. Now, if the tax holder decides to fund the ILIT with gifts, meaning they contribute money to the trust to pay for life insurance premiums, those gifts can qualify for the annual gift tax exclusion. But here's the catch: if they make a direct gift to someone, they could trigger gift taxes. With an ILIT, however, it is possible to use certain legal strategies, like crummy powers, to make those contributions count as gifts that beneficiaries can access temporarily without triggering gift taxes. Fourth is asset protection. Another big perk of an ILIT is the asset protection it offers, because the policy is no longer owned by the policyholders. The trust holds the policy, which means that if creditors come calling, they can't touch it. This is especially important if the holders are worried about lawsuits or financial problems down the road. The assets in the ILIT are generally shielded from creditors depending on the jurisdiction and certain legal factors, which makes it an appealing option for people wanting to protect their wealth for their beneficiaries. There is also the control over how the benefits are distributed. As the creator of the ILIT, policyholders get to set the rules for how their life insurance benefits are distributed. This could include detailed instructions on when and how the money is paid out to beneficiaries, whether it's in lump sums or over time. For example, if the policyholder has children and they want to make sure the money is used for their education or health care, they can make those conditions clear in the trust. This allows them to provide for their family while still ensuring they use the money responsibly. The policyholders will also have the tax-deferred growth of the cash value. Some life insurance policies, like whole life or universal life, have a cash value component that grows over time. With an ILIT, the cash value grows tax-deferred, just like it would if they owned the policy directly. This means they can watch their policy's value increase over time without paying taxes on it as it grows. What's even better is that, since the trust owns the policy, the accumulated cash value is also protected from creditors and excluded from the estate. Plus, they can borrow against the cash value of the policy, potentially giving access to funds without incurring taxes, providing they manage the loans properly. Tax avoidance also provides liquidity for estate taxes. This is where life insurance and an ILIT can help. The death benefit from the policy can provide liquidity to cover estate taxes without the beneficiaries needing to sell assets like a family home or business. It's a way of making sure the taxman doesn't force their loved ones to liquidate important family assets at a bad time. It may seem like they're evading tax, but actually, they're not. Tax evasion is the illegal act of intentionally avoiding paying the taxes owed to the government. It's a crime because it bypasses the system that funds public services, things like roads, schools, hospitals, and defense. Essentially, when people or companies try to hide income or lie about their financial situation to reduce their tax bill, they're committing tax evasion. But hold up, there's a difference between tax evasion and tax avoidance. Tax avoidance is legal. It's when someone takes advantage of the tax laws to reduce their tax burden, like using deductions or credits, or not declaring their income or falsifying the information to the IRS. It all begins when business owners decide to falsify their income by not reporting all the money they've made. Or they might underreport expenses, overreport losses, or even create fake invoices. These are just a few examples. Some people go as far as hiding assets overseas in offshore accounts to keep them out of the government's view. Just like individuals, large corporations are often involved in complex evasion schemes. They might use loopholes to make it look like their profits are elsewhere, dodging taxes where they should rightfully pay. It's like playing hide and seek with the government's money, but the stakes are much higher. Tax evasion can be done in a number of ways. One is underreporting income, the classic move. Some people just don't report all the cash they earn. The second method is inflating deductions. Some businesses try to increase their expenses on paper to lower the amount of profit they report. For instance, they might inflate the cost of materials or even list personal expenses as business-related costs. Third is stashing money in foreign bank accounts in places where taxes are low or non-existent, making it tough for authorities to track. Fourth is fake invoices and fake charitable donations. Some people create false invoices or fake charitable donations to reduce their taxable income. They might even invent a donation to a charity that doesn't even exist. How do people get caught? Well, tax evasion isn't something the government can ignore because it affects the whole system and they have ways of finding out who's evading. One of the most straightforward ways the IRS catches tax evasion is through audits. This happens when the government takes a closer look at someone's financial records. They compare reported income and expenses with what they should reasonably be. If something doesn't add up, they might start asking questions. Even whistleblowers do quite an effective job at reporting discrepancies. Employees, business partners, or even competitors might notice something fishy and report it. If someone blows the whistle, they can earn rewards for providing valuable information. Lifestyle audits can sometimes get people caught because their lifestyle doesn't match what they're reporting to the tax authorities. If a person lives large, drives luxury cars, and goes on expensive vacations, but their reported income is low, this might raise a red flag. Authorities may start digging deeper into where the money's coming from. But what happens when a person is caught evading tax? Well, it's not pretty. Tax evasion can result in hefty fines, back taxes, and in extreme cases, even jail time. And if they are caught evading taxes after already being warned or caught once before, the punishment could be even worse. Not to mention, being caught for tax evasion can ruin a person's reputation and damage their business.